I've placed this slide deck towards the end of the course because by now you should have a good understanding of how your business is working, and you can best match the organizational style to the business that you've chosen. A challenge that some new entrepreneurs make is that they choose organizational structures without thinking through what their business is going to be like, or how they want to run it, or even what success means. However, for you, now you should have some good ideas about what your future would look like with this business. And so now is a good time for us to figure out what sort of structure will fit with who you are and what your business is. The business structures that we'll look at are the sole proprietor, partnership, limited liability companies, limited liability partnerships, S and C corporations, nonprofits, and B corporations. Sole proprietorship. So a sole proprietorship is easy to form and gives you complete control of your business. You're automatically considered to be a sole proprietor if you do business activities but don't register any other kind of business. Sole proprietorships do not produce a separate business entity. Now, this means that your business assets and liabilities are not separate from the business assets and liabilities that are personal to you. That also means you can personally be held liable for the debts and obligations of the business. Sole proprietors are still able to get a trade name, but it can be sometimes hard to raise money because you can't sell stock, and banks are hesitant to lend to sole proprietorships. Sole proprietorships can be a good choice for low-risk businesses and owners that really want to kind of test the business idea before a more formal business. So some of the upsides of a sole proprietorship is they're easy to form. And the decision making, as it suggests by the name, you're the sole decision maker. You run the business the way you want to run your business, and you don't have to ask permission from anybody. Taxes. The IRS doesn't view your sole proprietorship as a separate tax entity, so there's no special or additional tax paperwork. You just simply file your taxes on the same way like a 1040 form as any other individual. Now, the downsides, liability. The lack of separation between you and your business leaves you liable for all debts and legal claims against the business. You can even be responsible for your employees' actions if you have employees, if they do something wrong while on the job. Funding is a problem. As I said, sole proprietorships lack a specific structure for raising funds. They have no stock to sell, no percentage of the business to offer. And business name. If you start a sole proprietorship, your business's legal name is your name by default, a fact that many potential sole proprietorships might not find appealing. Okay, let's look at partnerships. So partnerships are the simplest structure for two or more people to own a business together. There are two common types of partnerships: limited partnerships, LP, and limited liability partnerships, LLP. LP, a limited partnership, has only one general manager with unlimited liability, and all other partners have limited liability and limited control over the company. Profits are passed through to personal tax returns, and the general partner must also pay self-employment taxes. Now, LLP gives limited liability to every owner and protects each partner from debts against the partnership, so they won't be held responsible for the actions of the other partners. Now, partnerships can be a good choice for businesses with multiple owners, professional groups like attorneys or consultants, and groups that want to test their business idea before forming a more formal business. Some of the pros, less personal liability, more attractive to investors. There's more structure, and it can be member managed. But let's look at some of the cons. Self-employment tax. Taxation is simpler. Let's look at the cons. There's more administration. There are fees attached. More oversight from government. And really, one of the big challenges with partnerships is they can be very relationship driven. And so many people go into partnerships because they say, well, we're good friends and we'll be partners in this business. But to form a partnership takes some real marriage counseling. And it's important to look at how your decision making process will be before you enter into something like this. Okay, now let's look at S and C corporations. So a corporation, sometimes called a C Corp, is a legal entity that's separate from its owners. Corporations can make a profit, they can be taxed, and it can be held legally liable. So a corporation offers the strongest protection to its owners from personal liability. But the cost to form a corporation is higher than other structures. Corporations also require more extensive record keeping, more operational processes, and more complex reporting. Now, unlike sole proprietorships, partnerships, and LLCs, corporations pay income tax on their profits. In some cases, corporate profits are taxed twice. First, when the company makes a profit, and again when the dividends are paid to shareholders on their personal tax returns. Corporations have a completely independent life separate from its shareholders. If a shareholder leaves the company or sells his or her shares, the C Corp can continue doing business relatively undisturbed. Corporations have an advantage when it comes to raising capital because they can raise funds through the sale of stock, which can also benefit in attracting employees. Corporations can be a good choice for medium or higher risk businesses that need to raise money, and businesses that plan to go public or eventually be sold. So some of the upsides, like LLCs, C Corps are legally distinct from their owners. This separation creates liability protection. Although this asset protection is not bulletproof, business creditors cannot easily seize your personal assets to pay bad debt, and your personal assets are most likely safe from lawsuits against the corporation. Funding. C Corps benefit from multiple avenues through which to raise money. Employees. C corporations can offer a range of benefits to employees that generally make working for a corporation more attractive than working for other types of business structures. And keeping the company and the corporation. Although all corporations will pay their net income tax on net profits, those profits can be kept in the company without paying any additional taxes on that money, which is attractive to those who want to build capital or otherwise invest in their company's future. On the downside, there's that double taxation, right? If the C Corp issues dividends, the money issued to the shareholders gets taxed twice. And there's also the formalities, C Corp's formal requirements with boards of directors, official meetings, annual reports, and sometimes Byzantine federal and state requirements can make them slow and kind of, kind of cumbersome to operate. So, and C Corps must also file more paperwork. Now, as an S Corp is a special type of corporation that's designed to avoid that double taxation drawback of regular C Corps. S Corps allow profits and some losses to be passed directly to the owner's personal income without being subject to corporate tax rates. Now, not all states tax S Corps equally, but most recognize them the same way the federal government does and taxes the shareholders accordingly. Some states tax S Corps on profits above a specified limit, and other states don't recognize the S Corp election at all. So to understand the S Corp, you must file with the IRS to get S Corp status and register with your state. So what about nonprofits? Nonprofits don't mean that they're not allowed to make money. A nonprofit are organized to do charity, education, religious, literary, or scientific work. It's because their work benefits the public is that they're called nonprofits, and nonprofits can receive tax-exempt status, meaning that they don't pay state or federal taxes, income taxes, or any profit on what they make. Now, nonprofits have to do a lot of filing. They have to file with the IRS to get that tax exemption. And there's a different process within registering within their state. Nonprofit corporations need to follow organizational rules very similar to a C Corp. They also need to follow special rules about what they do with the profits that they earn. For example, you can't distribute profits to members or to political campaigns. Nonprofits are often called 501c3 corporations, and that is a reference to the section of the Internal Revenue Code, that most commonly uses to grant that status. Now, there's a new type of corporation, business structure on the horizon, which is very exciting. It's called the B Corp. So certified B corporations are a new kind of business that balances purpose and profit. They're legally required to consider the impact of their decisions on their workers, customers, suppliers, community, and environment. This is a good community. This is a community of leaders driving a global movement of people using businesses as a force for good. And many people will go to the certified B Corp website to see if a business that they want to do work with is certified. Here's a quick look at the B Corp Declaration of Independence. And even that first sentence really explains it. We envision a global economy that uses business as a force for good. And they have the rules, or they believe that they will seek, be the change they seek in the world. That all business ought to be conducted as if people and place mattered. That through their products, practices, and profits, businesses should aspire to do no harm and to benefit all. And they required to act with understanding that we are each dependent upon one another. It's very interesting with the B Corp and something to look at. Intellectual property. So, switch to intellectual property. Now, this is a category of property that includes tangible creations of the human intellect. Where most types of intellectual property, there are many types of intellectual property. Some countries recognize more types of intellectual property than others. Most well-known types of intellectual property, or IP, are copyrights, patents, and trademarks. Let's take a quick look here. So intellectual property, personal property created through creative intellect. So let's look at these top four. Copyright, and you know that circle signal. Those are creative works of art, and it attaches at the time of creation, at the time you make it. Actually, some of these slides, you can see the date is written by the person who actually created these slides. We know when it was created. Trademark, also TM, you see it's an identifiable brand and it attaches through use. The service mark is an identifiable service. And patents, they're new inventions, which would be a utility patent or an improvement on an existing invention, a design. For all of these, at WVU, we have an amazing patent librarian and an amazing patent library. And so one of the first things you do, if you think you might need to have one of these or be stepping on the copyright, trademark, service mark, or patent of another business, is go to the patent library and find out